Along with my day job running an investment business, I started Tinsley Park Talks, a global networking and leadership platform where I interview industry legends from finance to tech and great thinkers to notable celebrities. In these interviews, we discuss great ideas around investing, entrepreneurship, problem solving, and all other lessons of life. Welcome to another episode of Tinsley Park Talks.
Take a moment to please subscribe to the channel and like this video. We really appreciate your participation.
This program is in partnership with Nesh. For more information, please click on the link below. Scott Sperling is a pioneer in the private equity industry and co-founder of Thomas H. Lee Partners, one of the oldest private equity firms in the US. Join us for an insightful conversation as we unpack the journey of Sperling's background and THL's rich history in shaping private equity investments over multiple decades. Our discussion delves into THL's strategic approach, particularly in harnessing the transformative potential of generative AI. In a serendipitous meeting at a Copenhagen museum, we sparked a connection which ultimately led to this interview. Scott, welcome to the show.
Thank you very much for having me.
Yeah, it's so I have to share with our audience how we met really quickly. I mean, this is like October last year. I was visiting my cousin in Copenhagen, and she took me to this museum, outskirts of Copenhagen, not even downtown. It's like a fine arts museum, really cool little place. As I was walking around, checking out the different paintings and things, I stumbled into you, and I knew who you were. I just couldn't register your name and like just kind of place you in the right order. But I knew you were an investor. I knew I've seen you growing up, on CNBC and other outlets, and you were kind enough to help me with identifying you. And of course, rest is history. Thank you for your generous time and your willingness to come and join me today.
You're very welcome.
So we've had investors like David Rubenstein on the show before. You obviously have been around just as long, or maybe a little bit longer than Carlyle Group. I'd like to our audience to know the Scott Sperling before you became Scott Sperling with THL and all the success you've had. I'd like to ask you to share with us your upbringing. Where were you born? And how did you end up at Purdue? Maybe up to that, and then we can go forward.
Really quickly, actually born in the Bronx. Family all from that part of the country, from Bronx, Brooklyn. But as a child, moved away, mostly grew up in the Midwest. Went to elementary school largely in St. Louis, middle school, high school there. Probably major focus for me in those years was wrestling. Ended up going to Purdue, which is a place that from the time I can remember, I always wanted to go to. Ended up getting involved in a lot of different things at Purdue, mostly student government being a major focus for me there. Went directly from Purdue to Harvard Business School. Ended up graduating from HBS in 1981. One of the great things that happened to me there was meeting my wife, Lorraine, who was a year behind me.
Well, I've actually met with you at the museum.
In Copenhagen,
if you're watching.
And ended up going from HBS to BCG. Back in the days when BCG, I think, had 5 or 6 offices around the world, not hundreds of offices. Great experience for particularly a young person who had never really had much of a white-collar job up until the time I went to business school. Always worked either construction jobs or loading and unloading trucks for consolidated freightways during the summers. So it was quite the leap. And from there, I got called by a headhunter about taking a job at Harvard Management Company, running all their alternative asset investments, which at the time made up almost zero of the endowment. Over the course of a decade and change, 11 years, grew it to about 22% of the endowment. Private equity, venture capital, real estate, and what we call commodities. And then ended up joining THL. Tom Lee at the time had lost his one of his most senior partners, and I stepped in here to join what was a growing partnership, and have been here ever since.
That's a great story. I was curious, like how was that experience at Harvard Management Company for 10 years, and how did that prepare you for Thomas H. Lee? And I kind of just curious how they found you. Was it like, were you guys investing at the Harvard Management Company at THL at the time, or was there some other way you knew?
So Harvard Management Company was really a great place to be in those days. The founder and CEO was a guy named Walter Cabot, who was also the assistant treasurer at Harvard. It was one of the few places that had been set up and had the scale to manage the money of a large endowment like Harvard's, separately from the university, but for the university. I think I spent the first few years every 6 months visiting the Harvard Corporation, which was the governing board that's now become somewhat famous, but at the time was much smaller and not as well known. And I was very fortunate that there were a number of people on that 7-person corporation who were big supporters of investing in things that university endowments had never invested in. Again, leveraged buyouts, venture capital, real estate, that sort of thing. And so I was able to build an organization at HMC over that decade. A lot of other folks came out of HMC from some of the other areas to start hedge funds of various types, public equity investing funds. And I had co-invested in a number of deals with THL, and both Tom and a number of the partners here, and ended up joining the firm, as I said, back in 1994. Tom left in the late 90s, and the affiliation remained for a number of years. And then back in 2005, Tom left permanently to go to New York, and been leading the firm along with a couple of different co-presidents and co-CEOs of mine over the last couple of decades.
Great. And if you were to just compare the 80s and the 90s and how private equity deals were getting done then, and compare it to where we are today, and how would you describe private equity in its evolution?
I think private equity has gone from something flying way under the radar, where a lot of sellers didn't appreciate the power of leverage in driving returns. So back in throughout most of the 80s, returns were had by using more of a financial approach to creating value, buying an asset, usually single-digit multiples of cash flow, using a reasonable amount of leverage, and that leverage would often account for up to 90% of the capital invested in that company, and then being able to drive strong returns there. Through the 90s, things became a little more competitive. Sellers realized the power of leverage, and pricing kind of across the board went up, and we needed to look for ways to help create value, which during the course of the 90s, all the way through, I would say, the middle part of the first decade of this century, really manifested itself in finding the right management team to partner with, pretty much helping them strategically and often through M&A to create value. If I then leap into the last decade and a half, I would say that what we have found is the need to create value operationally, the opportunity to use both our acumen at running M&A but then combining it with having people who have operating expertise to help portfolio companies get to a higher level of operating performance has become the formula for success. I know as a firm, we invest very heavily in highly specialized professionals, investment professionals who focus very narrowly on one subsector, who understand that subsector thoroughly, have a Rolodex and set of relationships that matches any strategic in that area. And we combine that domain knowledge with a large group of operating experts who are partners in our firm and work in our firm just like investment professionals do. In fact, they work on a deal team that's fully integrated between domain experts and operating experts. And our operating experts are a resource for company managements to help improve key business processes in ways that will accelerate revenue growth and improve the efficiency of the business model to generate higher levels of cash flow and have higher rates of growth in the cash flow of companies than the company that we bought. And that is a formula that's worked quite well for us for a decade and a half. And we continue to invest very heavily in people who have that expertise, whether it's domain expertise in various subsectors that we're focused on, or it's operating expertise in ways that we think we can help portfolio companies.
Yeah, speaking of operational efficiencies and domain expertise, obviously that's very key in private equity. That's been my experience as well, working in private equity. Fast forward to today, generative AI sort of entered the scene, and speak about productivity and domain expertise. It's productivity on steroids right now. But the question is, how to specifically apply the generative AI technology into existing portfolio companies. So if I want to ask you a couple of questions about what is Gen AI's role in private equity, or what is private equity's role with the advent of Gen AI today? How would you incorporate AI in your investment thesis today?
So taking a step back, I think for a number of years, Todd Everick, my co-CEO, and myself have been working with the people who lead our vertical investing groups, who are members of our management committee, to think about how technology helps improve the performance of companies across our economy. So what are the ways that we can help companies do what they do better? So that has led us to becoming a very significant investor in things like pharma services, where for 25 years, we've been investing in companies that help biotechs and pharma companies do what they do better, whether it's clinical research companies or companies like Thermo Fisher Scientific, where we first bought Fisher Scientific back in the mid-1990s. I'm still on the board there as a lead outside director, but we've seen enormous growth in being able to help companies in life science, in healthcare, do what they do better. And we've applied that model now across the board in other areas of pharma services, but now also in automation, helping companies, whether it's industrial warehouses or distribution centers, or lots of different companies that help even white-collar tasks become more automated and more efficient. We've invested in financial services and fintech companies that, again, bring new technologies to bear for customers in ways that are more cost-efficient for them and that also help them perform their crucial tasks better. So when we thought about generative AI, we thought about it in the context of another technology, though a technology that had made major leaps, that can help companies across a very broad spectrum do what they do better than they're currently doing it, do it more cost efficiently. We thought about technologies that help the employees of a company have more time to focus on the high value added tasks and help relieve them of some of the more mundane tasks. So as we thought about generative AI, we first thought about it as what are the opportunities to use that technology in existing portfolio companies that serve a broad array of industries, but help them do it better. And so we've had major projects. Jim Carlisle, who runs our technology and business solutions vertical, he and his team have been very focused on thinking about how generative AI impacts companies that we've invested in and how it impacts companies we might want to invest in ways that identify both challenges it might present to their business model, but even more importantly, opportunities that our companies might have to incorporate these technologies in providing the services and the products to their customers. And so we've been working on this for over 2 years, thinking about how generative AI, as it evolves, will become a very significant positive tool for the companies that we've invested in and the kind of companies that we're looking to invest in. So that's a whole area for private equity that goes to the heart of what we do to drive high returns for our investors. There's another aspect, which is how might we use generative AI in our own business, both to reduce certain administrative burdens, make the ability to have data available to our executives, to our investment professionals, our operating experts, and to those of us who manage the firm, have information that is better and more readily available to help us in our day-to-day tasks of identifying attractive investment opportunities, of evaluating those companies, and then in making decisions. So there's a lot that goes into your question about generative AI.
Right.
I know I've run on, quite a bit on it, but it really impacts so much of what we do in private equity, both investing, managing our portfolio companies, and then how we manage our own business.
Yeah, no, that makes perfect sense. I'd just like to help us and our listeners bifurcate a couple of things in terms of how Gen AI is being used today. We're talking about the enterprise customers. We're talking about enterprise applications of generative AI, which is not apples to apples with, OpenAI and all the sort of incumbent giants that are out there that are, that you and I are using as consumers, which we tend to frown upon the hallucination aspect of it, right? And we kind of take that away in my understanding. And I know a little bit about it because we are an investor in a mid-stage generative AI company called Nesh, and we're thinking about it all the time. So I guess I've heard you speak in another interview, and you specified texture of the knowledge in its domain of Gen AI. If you don't mind expanding a little bit on the texture of the AI and the domain focus that you talk about, how is that relevant in private equity enterprise investing?
Well, what we're looking for are ways, again, of creating an advantage for customers of companies that we invest in, and using this technology to provide a product or a service that allows those customers to do, again, what they do better. And let's take some examples. So, and this intersects with some other things that I do. So I serve as the chair of the board of the Mass General Brigham healthcare system, which is the largest high-end clinical and research system in the world. And we have an enormous research operation, again, the largest recipient of NIH funding. We have one of the largest clinical operations, particularly focused on providing the kind of care that you can't get almost any place else in the country. There are a couple of handful of places who can deal with the kind of very complex medical problems that our folks deal with. And so we're looking for systems that help us take the massive amounts of data that we have from both the research side and also the clinical side, the patient side, and incorporate that into data lakes where we don't have the hallucination problem. So we're not going into the broader world, but we're looking for ways to take massive amounts of data that we've accumulated and then apply a variety of AI techniques. Most of the ones we're talking about now are generative AI as opposed to the more traditional type of AI that would allow us to process information much more efficiently, reduce the administrative burden on physicians, which is a huge problem in this country. Shockingly, physicians spend over half their time on administrative matters having to do with the EMR systems, the electronic medical record systems, and with collecting information and processing information for purposes of their rev cycle or the way that they bill and get paid. And there are ways that generative AI can significantly reduce those burdens for the physicians, thereby increasing the capacity that we have to serve patients, and take the data and process it in ways that help draw out information that can lead to better diagnoses, better therapeutic answers for patients with a wide variety of diseases. So this is a very large area of opportunity for the country, for the world, in order to reduce medical expense, but get much better at providing healthcare. And there will be a lot of opportunities for companies to go in and create products and services that allow what I've just described as an objective to happen. Now, take that and then apply it across many other sectors. And in each case, we're again trying to look for ways to reduce administrative burdens, increase the ability of companies to make better decisions, improve the ability of employees to focus on the parts of their job that are more enjoyable, that are higher value added, while reducing the burden of the more mundane tasks that often take up a huge percentage of their time.
Spot on. So we talked about all the ways existing business models can be improved, made more efficient. What about some of those business models that you might think that would get disrupted by Gen AI? Any that come to mind?
Well, one has to look at the way that Gen AI is already perfectly suited to do things that many companies have thought were high growth areas, and coding is one of them. So what we've learned is that the generative AI technology is great at writing software code and at proofing software code. And there are lots of companies that were created to help software engineers in the more traditional way create and proof and improve their code. So this is just one example of an industry or a subsector that we had thought was a very good high growth area, where generative AI is going to significantly challenge the way the business model works. You can also look at things, accounting services. Generative AI will create a set of tools that will make that a much more efficient operation, a much lower cost operation. What's the impact on accounting firms? So you can look at a number of businesses where generative AI may significantly improve efficiency, but where it may challenge the business model of companies that have been performing those tasks in a more traditional way and generating relatively high margins by providing those services to customers.
Interesting. So to tag along with the accounting services comment, do you think it will impact private equity firms to have smaller teams because now you'll have financial modeling done in a lot more efficient way than actual investment team members doing them.
Yeah, again, I think this goes to, you take a task that's probably one of the least enjoyable tasks for our younger professionals, which is the
Right.
massive amount of modeling they're being asked to do.
Right.
Back when I started at BCG in 1981, we didn't actually have computers at all in those days, let alone modeling capabilities. So, I would have my calculator and I would have semi-log paper and I would do my own calculations. What that meant was I had to think really hard about what were the scenarios I wanted to run. So a lot of thought going into what do I want to run as a model that I now had to do by hand. When you skip to today, where we have these young people who are really good at modeling, their bosses, I would say, sometimes they don't think too much about what the right scenario is. They just say, run them all. And you know
Yeah.
what? Take a look at that, run another 20 of them.
Right.
And so, as we pull that back and we say that we might be able to do that, perform those tasks with a system, it may give us the ability to take that step back and think more about the underpinnings of what we're doing, understand in finer granularity the nature of the business that we're thinking of investing in, than just running a whole set of models that we charge our young people to do. At least that's my hope.
Yeah. It is also interesting. Things are moving so fast. These models are getting updated so quickly and becoming so much stronger than the previous versions.
Well, just think about how quickly we moved forward in ChatGPT,
Yeah.
the original to GPT-4 plus and beyond, it seemed like months, certainly not years, but just months in between the releases, where they made orders of magnitude improvements. And I think that's what we're going to be seeing as we go forward here. The issue that you raised about hallucinations, how do we take this enormous amount of data that's publicly available and cleanse that in ways that eliminate that problem? I'm sure there are companies out there working on that right now, because once we're able to do that, then I think we're going to make even greater leaps forward.
Got it. Got it. I just want to ask you one more question about the Gen AI principles in your theme, investing theme. We tend to think that Gen AI is a secular trend at the moment, but you still have to mine through what's secular and what's not. How do you think about what's that balance there as you're thinking about the applications in all these companies, the portfolio companies, in what makes a company privy to being secular in nature versus not secular in nature with Gen AI?
So it's both. That's both a Gen AI question and even a broader question that we've long dealt with. Our focus is on sectors, and not even on sectors, really on subsectors that we believe have very strong secular growth drivers that are sustainable over long periods of time. And so we're looking for places where the nature of the product or the service is meeting a growing demand that had not been realized by prior technologies or capabilities. And so I think generative AI gives us that ability to solve problems and offer products and services that had not been realizable with legacy technologies. And so in all these areas that I've been talking about, all the ways to improve productivity, all the areas where we can create the ability to make significant leaps in the nature of life science or information technologies, I think that presents a real secular growth driver that does have long legs to it. And I think we're going to continue to see generative AI be an underpinning to orders of magnitude improvements in the nature of the tools that we have to to deal with the kinds of problems that have been very difficult to deal with legacy technologies in life science, in financial services and technology, in information technologies and services.
Got it. I would like to speak about your playbook these days. We obviously talked about AI. That's a big variable. We'll hold that thought there, but can't ignore the macro backdrop with rates, elevated rates, high inflation, and my research indicates that you've seen maybe 7 recessions or so in your lifetime.
That sounds about right. Sounds about right.
And if you're doing 4 to 6 deals a year, how are you? What's the playbook for THL in going forward?
So, again, we've invested incredibly heavily in people who have the kind of expertise I was talking about earlier, people who live within a subsector. This is what they do. This is what they know. We identify thousands of companies that fit within the various subsectors that we invest in. We even have one of those nice little names for that, ISO, or Identified Sector of Opportunity. And we're continuing to bring people in who either grew up in those areas as investors or operators, or who will focus because of interest in each of these areas. And so for us, the focus is on people who really want to focus in these subsectors and help us know more and be better at identifying opportunities, evaluating those opportunities, and then managing those companies. And we combine that again with people who have a long history of operating experience and expertise in areas that will help these companies perform significantly better in both the revenue generating side and the operating efficiency side of things, so that we can accelerate revenue growth and accelerate cash flow growth. Again, that formula has worked extremely well for us from a performance perspective over the last 15 years as we migrated from a firm that was traditionally a generalist firm that looked at a broad range of opportunities, so generalist and opportunistic, to highly specialized and having significant capabilities on the operating side of things. And we believe that investment has paid off well for our investors and for ourselves. And we just see continuing to double down and invest in both of those areas, domain expertise and operating expertise, and organize that in ways that allow us to, again, identify great opportunities and then take advantage of them.
And what about the macro situation? We've had very elevated rates, fastest growth in rates since World War II. How do you factor that in as you use leverage in the deals, and how do you see that playing out in the next 2-3 years?
So it has to be factored into valuation, entry values, and entry multiples. I think as we look at it, rates are probably going to stay in the, let's call it the 3 to 5% range for the 10-year. There may be periods where it jumps for short periods. There may be periods where it may decline slightly, but it will be in a range that when you look long term, you would say those are moderate rates. And when you look at the long history of private equity, we have certainly performed very well in periods where rates were within that range or somewhat higher. So it's not that these high rates lead to poor returns. It leads to good returns, assuming that you adjust entry multiples to match the fact that exit multiples will be lower than in an environment where interest rates were effectively zero. And we have been through a period of the last 18 to 20 months of seeing prices adjust in the private markets to reflect that reality. And we've been very disciplined about it. Last year was a year where we only bought 2 companies, not our normal 4 to 6, as we were waiting for those adjustments to happen. Again, we invested in the organization in ways to continue to build capability in preparation for what we anticipate to be a better buying environment this year and the year after. But one needs to adjust the entry multiple to reflect the reality that we're probably not going back to free money.
Right. And do you think the GP-led secondaries markets kind of offset that challenge in some ways in the last few years?
GP-led secondaries, I think, make good sense depending on the nature of the company. But I would say that the people who invest in secondaries are also very careful about valuations. It's not that the GP can just state a valuation and the money flocks in. I think it has to hold up to the kind of scrutiny and diligence that these secondary funds are doing. So yes, GP-led secondaries have been a way to get liquidity for investors at a time when it's been harder to exit otherwise. But I don't think it's a panacea for the industry.
Got it. Yeah, and I just want to maybe revisit or ask you a question around an investment that you had in a company that was very heavy in technology. I know Clear Channel was one of your largest deals. I remember reading about it in Wall Street Journal when I was in college.
Mm-hmm.
And I wanted to kind of ask you to use an example of a business where you invested in the company and then there was some huge, secular shift in the technology itself, like a disruption in technology itself, perhaps. And how did you manage through that?
So that's a business that's a very large media business, legacy media business. It was less a direct technology shift. There obviously was a shift in the way people listen to music. So Clear Channel became iHeartMedia. iHeartMedia is now the largest podcast company, as well as continues to be far and away the largest radio station company, but also in many other areas of media. The nature of listening evolved, but interestingly, 92% of the American public still listens to traditional radio on a daily basis, and yet they will also listen to music in many other forms, mostly through streaming. And so you're sharing now because technology enabled people to be able to listen in ways that were different than you were able to do 30 years ago. But there's still a place for things like traditional radio, which takes its content and now distributes it not just in the traditional over-the-air way, but also through streaming, and is heavily involved in live music, which is one of the growth areas for the music industry. So you have a company that has adapted what it does, taking its core content and then using technology to be able to distribute that in new ways. So it's not quite a technology company in the way that we focus on technology, but it is a company that utilizes technology to meet the evolving needs and preferences of its incredibly large listening base or customer base.
Got it. Okay, I want to switch gear to like the future of private equity and what you think of the future of private equity. Let's say in the next 5 years, if you were to guess the new fundraising activity in general in private equity, do you anticipate more sort of first-time emerging manager buyout funds coming out more than incumbent funds just raising larger and larger funds?
I think there's always room for new managers. It's a very large market. There's um, a a wide range of investors who have now understood that private equity drives superior returns relative to other asset classes in almost any kind of an environment and over any time frame, 1, 3, 5, 10, 20 years. Private equity, particularly North American buyouts, most particularly, has consistently outperformed. And therefore, it's an area that gets an increasing allocation from pension plans, sovereign wealth funds, endowments, and many others. And now there's a growing market, retail market, who would like to tap into that form of investing in much larger ways than they ever have before. So the universe of dollars available for private equity continues to grow pretty significantly, and that may open up the opportunity for a wide range of managers to start firms, grow their firm, grow their funds in a number of different ways.
Got it. And I want to ask you a question about perhaps a convergence between a venture capital investment and a private equity investment, specifically in enterprise software terms. We all know the big guys like Vista and Thoma Bravo, and oftentimes they're doing buyout deals, companies that don't have profitability per se, but they're like close to breaking even in profitability. How do you think about that sort of, you know, that convergence line between a company that you're about to invest, let's say a platform company or even an acquisition add-on company to an existing portfolio in terms of valuation, in terms of structure?
So we tend to focus on companies that are profitable, that clearly have proven that their product or service meets a customer need, and where we see a pathway to helping that company get to a higher level of performance, help them improve things in ways that allow them to take market share and to take advantage of subsectors where we think there's very strong secular growth. So, for us, we're really more focused on the more profitable control type investments that I guess have been more traditional in the buyout private equity world. Obviously, we have periods where startup venture capital has been an incredibly good place to be. Periods where it's very difficult. And in the middle are some of the kinds of things that you're talking about. We used to call that mezzanine investing, mezzanine venture investing, or people now have started to call it growth equity investing, where you're buying a company based on some multiple of revenue or anticipated, revenue, as opposed to a multiple of cash flows. I think our level of comfort has been best with the more traditional multiple of cash flow approach, recognizing that there are new and emerging companies that may be really interesting opportunities, but we'll more often leave that to the venture capital players in situations where they're not yet at the point of generating significant revenue, let alone profitability.
Understood. So we're almost close to our time being up, but I'm big on values and principles.
Okay.
I tell when somebody asks me what's your podcast all about, I say only invite people that I respect and admire. And obviously, I respect and admire you, and that's how I recognize you.
Thank
So I
you.
wanted to share with our audience what was the most valuable life lesson, if you could share with us.
I think it's probably a cumulative life lesson, but I've been very fortunate to, as a young professional, um, to work with some really outstanding bosses and leaders who reflected what I've always valued, which is that one has to have incredible respect for others. There's, whether you call it the golden rule or lots of different ways of saying it, but it's basically treat others as you would like to be treated. And so let's start with that. Recognize that we are all, success often involves some level of good fortune. That one of the worst enemies of long-term success is hubris. And when you put those things together, the values that we have here, we really value humble. We value high levels of intellectual honesty, the ability to communicate and discuss very openly a broad range of opinion, but do it in a way that is respectful of others. And again, acknowledge that those of us who have had good fortune, that's a blessing, and we owe it to our communities and to our families to give back in all the ways that one can. Those are the kind of the core things that as a parent and grandparent that have been important and I'm very blessed to have a wife who not only is extraordinary in all of the things that she does and leads, but also shares those exact same values. And so we try to practice that in our personal life. And I know, again, Todd and I and my co-president before Todd, Tony DeNovi, we all have shared this view. And I think it really reflects and the culture of the firm that we've built over a long period of time. And so, we view our obligations to each other, to our families, and to our communities as incredibly important, and we hold those values very dear. And we also hold our indebtedness and our effort to our investors, people who we have had long relationships with, friendships with, and feel a great obligation to do everything that we can to perform for them as another great part of our lives, but also as another crucial part of the culture of our firm, but one that's just an extension of the values that I just mentioned.
It's amazing. Mr. Sperling, this has been an absolute pleasure. Thank you so much for sharing all that you did today in regards to your wife. And I hope I get to meet you guys again sometime if it's meant to be. But thanks again and look forward to being in touch.
Thank you very much.
Take care.
It's my pleasure.
Hey guys, if you liked watching this video, I think you'd also like these interviews that I've done in the past with people like Anthony Scaramucci of Skybridge Capital, David Rubenstein of the Carlyle Group, Carla Harris of Morgan Stanley, Oswald Demotin of New York University, to name a few. We appreciate your participation, and we love the likes and subscribe that you do to the channel, because it only helps us grow and create more content for you. So hope you continue to do that. And we love having you back, and see you soon.